Welcome back to Reformed Millennials, the podcast where finances, economic trends, and sports intersect. Cam and Joel help listeners better invest their time and money. Also, it's important for listeners to understand that investing in equities, fixed income instruments, and/or alternative asset classes involves substantial risk of loss. Any action you may take as a result of the information presented in this podcast is your own responsibility. The information in this podcast is presented as a general educational, informational, and entertainment resource only. While Joel is registered to provide investment advice, this podcast does not provide individualized investment, tax, or insurance advice, nor is it meant as a recommendation to any listener to buy or sell any specific securities or otherwise take any other form of investment action. This is an excerpt of the full legal disclaimer that's available on the landing page of this podcast, which includes whether Cam Pitchers or Joel Shackleton have any ownership or interest in the specific securities discussed in this podcast.
Wednesday morning.
Happy hump day, everyone.
It's a short week between posts. We had a glitch, or I should say Substack did. I couldn't post Friday because it was down, and through to Sunday. And then Sunday, Monday for me, I was driving from Invermere back home. Big week, big long weekend in Canada. Pretty tough to get out some content. So I apologize for the delay.
No one would have listened to us anyways.
No, definitely not. This is, by all means, the slowest time for content consumption on our end. So
yeah, we were saying last week, dog days of sports. I think it's just dog days of content in general. I think you're right. That doesn't matter what you're talking. I mean, I would say like your favorite content creators are obviously probably still on schedule and are doing their same thing. But across the board, even if you were to look at views on YouTube videos, etc., everything's down in comparison just because people have other things to do.
Actually nice out. So what I want to talk about today, well, maybe I'll just do a little bit of a rundown. We have market update out the gate. It is earnings season, so I do need to cover kind of what's going on there. There's been a ton of tech news, AI news, all of that has been kind of hot off the press and coming out almost at a pace in which I could barely keep up. So it hasn't slowed down this summer. But additionally, we had some big news in sports. I also listened to a phenomenal podcast around mostly the United States housing market, but I actually think that it is a really good barometer for Canadian real estate, and I want to talk about that a little bit. And then there was a release on the annual valuations of sports teams that I kind of want to talk about a little bit, and obviously the Barstool, Penn, ESPN, Disney news that just dropped this week.
Yeah, August 8th, yeah.
It's been a long time since I've had to pay attention to Barstool Sports and Dave Portnoy, and I'm a little bit excited to see them back in the news. So let's talk about that a little bit. But just to kick it off, we had last week Berkshire reported on the weekend, and I think that along with Walmart, Berkshire Hathaway is a really great barometer for where the U.S. economy is. I mean, if you just think about all of the businesses that they own, I think it ranges all the way from Apple across to railroads and everything in between, insurers, oil and gas companies, service businesses, gas stations, See's Candy, name it, they probably own it. And it's quite clear that the consumer is slowing down, especially when you look at the rails who deliver a lot of these goods. And while you see trucking volumes increasing, rail volumes are decreasing, the economy isn't chugging along at the same pace that it was in 21 and 22. And it's quite evident inside of the Berkshire balance sheet. Additionally, and a lot of analysts drew attention to the fact that they are building up cash again. So their cash hoard is now in that $160 billion range, which is obviously insane. But luckily for them, they get to have that in U.S. Treasuries or Canadian GICs. And, well, not actually in Canadian GICs, but you get what I'm saying. And it's clear that they're waiting for something to happen. I don't think they know what that is, but that is usually they've made or they've done a lot of their investments that they felt they needed to do over that 3-year period. I think they did miss in 2020, and they're hoping that there's some sort of opportunity that comes up in the next year or 2 years. They are a notorious for being able to outweight anybody. So we'll see what they do with that, and it could get to 250 before they do anything with it. But my guess is they feel valuations are fully baked in based on earnings per share right now. And a lot of analysts are saying the same thing. So I'm a big reader of DataTrek, and I post something about it every single day in our Notion or our doc. And they've effectively come and said that the biggest and most important thing for us to be paying attention to is the US 10-year. And it's kind of trading like it's about to break out, which to me suggests that we're at a near-term high with regards to equities. And the current risk premium that you're paying for equities is not really worth it. And this is me not giving investment advice. This is just me talking about where the market sits today. And it's just a fact that 2.7% of stocks drive 100% of the returns in markets. Not 100%, but most of it, of the upside in the markets. And bonds outperform a large majority of equities over the long period of time. And right now, if you're looking to put cash to work, it just makes a ton of sense for you to go short duration and clip the coupon, whether it be corporate bonds, short duration bonds. Stay on the short side of that curve and kind of wait for whatever is about to happen, because equities have run hard. I mean, the S&P was up 17.5% this year. The NASDAQ was at one point up 40. It was the hottest 6 months in its history. So for us to digest and see a rejection at what looks like all-time highs for the NASDAQ and the S&P 500 makes a ton of sense. It's called overhead supply. And just looking at the charts, it's quite clear that we're running into some of that, and people are starting to take some profits. They've had a great year, especially if you were long equities going into it. So that's what's happening right now. The thing to pay attention to with regards to stocks right now is profitability and revenue acceleration. So if we're actually going to see continued upside over the next 6 months, you really need to see profitability improve. So this means cost cutting by our large corporations, but then also an outperformance on the upside. So right now, and this is from DataTrek, they are looking at what analysts and the market is pricing into growth in financials, materials, energy, healthcare, industrials, et cetera. And the only sector that they expect to grow for the remainder of this year is tech, and then also grow next year at an 8.3% pace. I think that's telling. The only thing that I believe is mispriced a little bit right now is energy and materials. Otherwise, we're pretty fully baked in. So,
and I think to, I guess, pull from commentary from prior podcasts from you talking about the run the equities have been on, the initial prediction that interest rates are at their peak, at least for based off of data that's available to us right now. Obviously, we know things can change on a dime depending on the monthlies, but essentially that change in interest rates is, depending on if you're talking about US or Canada, is Q1, Q2, maybe even Q3 of 2024 is when those changes are going to happen.
Yeah, if we're going to get an actual cut in rates, it's not coming this year. At least it doesn't look like it's happening this year.
And you can tell me if my simpleton mind on this is too simple, but in the sense of equities being, as you put it, potentially at a high right now based off of some of the indicators, it's almost like everything that it's run its course in terms of pricing all of the, I guess, maybe consumer activity, and the market's always 6 to 9 months ahead, as you famously said a few times, right, on this podcast, maybe once or twice. I can't remember, 1 or 2,000. And it's an important thing to think about. And I guess just, again, with me learning more about the prediction models that would be in place, that kind of makes sense to me, that now it's like, well, we've had this great 8 months or 7 months of equities, and now it's time for that pendulum to start swinging back the other way. And we have to think about how you're putting your money to work, and whether or not another 20% growth on holding equities for the next 4 months is probably not something that is going to happen.
Well, exactly. So I mean, again, not financial advice here, but markets tend to discount events that are 6 to 9 months out, which tells you that we're looking at Q4 2023 earnings right now. So when you see a stock move today, it's likely pricing an event out in the future. So let's say, for instance, yesterday we had Shopify and Snowflake all get smashed. And that's mostly because of what people believe is going to happen in Q4 2023. Not today, 2023. And that's an important mindset to have when you're watching the market every single day. A lot of people think that it's because of something that happened in the past, when in reality, it's everything is looking forward, especially in public markets. This is not private. This is not something where you have control over anything. This is truthfully them reporting what they foresee into the future. And that there's a ton of variables that go into it.
It's not a sports contract where you get paid off your past performance.
Exactly. Sadly, and I mean, for the better, probably, most CEOs are stock comp, and they're always controlling for short time horizons. This is where there's a big difference between a founder-led company and a CEO-led company. A CEO who's been appointed to that seat usually has a comp package that is, let's call it 3 years in length, maybe 5 years. And their goal that the board sets out for them is almost always stock price performance. It's not there are other KPIs and that they're looking at, but generally speaking, that's the duration. Whereas Mark Zuckerberg, when he's managing Meta or Facebook or Instagram, whatever you want to refer to it as, doesn't think about it that way. He's like, I'm 38 or 40, and I'm in the middle of beating up or trying to beat up Elon Musk.
You found the right octagon to get into.
Yeah. And my view is that I want to do this job for another 20 years. Where can I take this business, right? So when you're buying an individual security, you really need to think about that. Who's in charge? What is management trying to accomplish? What am I trying to accomplish in buying this equity? Because, as I mentioned earlier today, most stocks underperform long duration bonds. And if you're going to be a stock picker, you really need to get to understand the incentives, because incentives drive all decisions in life. So you got to understand the incentives of the person who's managing your business. These are all imperative for you to understand.
And also gives you the foresight or the understanding of how do I think I'm going to make a return on this investment?
Exactly.
Is it going to be a 12-month return, and then I'm going to switch it up, or is it going to be I want to hold Facebook until I'm also 58 years old?
Exactly. Because if you are doing that, well, then you should be able to stomach the outrageous 70% declines.
Stop opening up your portfolio valuation every single day.
Exactly. Yeah. So that's kind of my update for the day.
I saw one thing I just wanted you to, because you've talked about this 1,000 times, but so there was I didn't share this with you yet, but on App Economy Insights, just talked about Apple's performance. So they made $21.2 billion last quarter. So that was more than Netflix, MasterCard, Spotify, Activision, and Peloton combined.
Yeah. I mean, it's really important. I'll use this as an analogy. Their headphones would be in the top 25 of S&P 500 companies if they were to just spin off AirPods.
Headphones, yeah.
That's how big Apple is. It's impossible to truly understand just how big they are. Their business is bigger than Canada from a market cap perspective. The market cap of Apple is nearly $3 trillion. The market cap of our Toronto Stock Exchange is not $3 trillion. That is how big Apple is. So
I know we haven't talked a ton about it. Like, I mean, this podcast I don't think would have started before that, but like the transition to Tim Cook, it's kind of just a crazy story. Like,
he's one of the GOAT operators of all time.
Because like there would have been a lot, and rightfully so, in terms of that transition, there would have been a lot of, I'm going to say haste, but just uncertainty around that. And how can someone build off of this to make it the same kind of growth that had been seen previously? And he's really hit it out of the park.
When did he take over? 2013?
I have this crazy thing in front of me called a computer, and I will check.
So let's assume I'm right, and it's 2013. It might be 2011. But
Yeah, 2011 he took
2011.
over. Yeah.
Okay. And at that time, I'm just looking back, and again, people need to understand that this is rough, but they've also done 3 stock splits or 2 stock splits since then. But the stock in today's price was trading at $10 roughly when he took over, between like 8 and 10. Today, we're at 177. Not bad. Not bad, Tim. At that time, I actually remember where I was sitting when Steve Jobs was diagnosed with cancer. They gave him like 3 months and resigned. I was sitting in the Sherwood Park Library doing nothing probably. And I can't remember who was sitting across from me, but I remember reading it. I remember the direction I was facing, everything. And at that time, the market was like, oh no, Apple is toast. Their founder and innovator is gone. They're never going to be able to iterate. The
Well, and that
stock
mentality,
went from 21 to 12.
And that mentality that you just talked about, a CEO-led company versus a founder-led company, you've lost this founder leadership, and probably what the basis was for a lot of people's trust and confidence in the long-term vision. And so when you bring somebody third party or an outsider,
Well, he wasn't even an outsider, so he was their supply chain guy.
Well, yeah, he I think I'm just reading the wiki, which is obviously 100% correct all the time, but he was with IBM pre-Apple, and then in 98, Jobs asked Cook to join at that point. So he had been around for
10, 12,
Yeah.
15 years
Yeah.
at this point.
Yeah.
So he takes over. He was, I believe, their supply chain guru. Big reason why they're in Asia. I think that one of the biggest assets Apple has is their supply chain diversity, and the fact that they can generate 40+% net margins on a lot of their hardware is unbelievable. It's a testament to their brand, but also their efficiencies. So,
And I know you said you're going to have a little bit of an AI update potentially here if we still have time for it, but that's one thing I've been kind of reading just in little articles here or there, nothing that was too deep or like specific, but just saying how I think even on this podcast we've been talking about Google and we've been talking about Microsoft. We haven't really been talking about Apple too much in the AI space.
yeah, they like to come in second.
And it's basically talking about the predator that's waiting in the grass, like in the long grass kind of thing, to pounce and to release something that's going to be that much better. And I think we've talked about this in the form of Facebook or Meta and what Zuckerberg has been able to do and take things and improve upon a base platform or a base service. And I think Apple obviously can do something similar with the resources that they have at play and just a tad bit of cash. So I feel like maybe
They can do a lot. I think a good way to think about Apple when it comes to artificial intelligence is the fact that they still, and this has been a big new debate online where everyone's trying to think about where the Everything app is going to be. And I'm of the opinion that North Americans will never have an Everything app. We don't like complete control. The closest thing we have to it today would be split, in my opinion, between 3 businesses, which is you have the Apple OS, which is the everything company. And then you have Meta, which owns the 3 largest platforms that we participate in.
for messaging and socials.
For those that are not inside of that, you have Google, which I think has its own subset with Android, YouTube, Google Search, Bard, that whole suite where they have, I think they have something like 8 apps with over 500 million users and 3 or 4 with over 2 billion. It's an unbelievable app ecosystem. So you have these 3 everything apps. I don't believe North Americans or Western society will ever have something that you pay bills on. You also you're doing your homework on, you're communicating with your children and your friends.
Doing your grocery shopping.
I don't view that as that ever being something that we do. We have the 5 most valuable businesses on earth that are all vying for that space. It would be super odd to me if we ever found a home for everybody in one spot. So,
and I'm sure the sentiment around that and a company has a mission to become the everything app if we were to get them in a candid moment, that would mean just getting X market share of, like, if you get 20% of people using your app for 80% of their user needs, that's going to be a really good business. So I know that you had shared an article about, it was an opinion piece and the caveat would be that he's a portfolio manager who holds a lot of Uber, but that Uber has been performing decently well, I think, from a stock perspective in the last 24 months or 12 months. 12 months. And has been continuing to add services within their app to make user experience better and keep things at their fingertips, which I think from my recollection of going into the Uber app, it is still mostly around travel and groceries and getting things delivered to your home, which is great. I mean, having those extra pieces to get I'm not sure if this is available in Canada or not, but they have examples of your prescriptions being picked up and brought to your home, and your groceries, obviously, and your liquor orders, and for all those things getting delivered, which I think provides a great service. I just don't know how that went, to your point about the kind of the end of the free service apps that we've talked about a few times before, is how much is this all going, in order to continue the scale that they need to have, how much is that going to cost people at the end of the day? Is it going to become too expensive where
I find it, so he's speaking about Josh Brown, who is the CEO of Ritholtz Wealth Management, which is a wealth management firm in the United States. They are one of the fastest growing RIAs in the country. He's a predominant figure on CNBC. He's not really a PM. He's a manager of a business. He speaks his mind. He doesn't have any clients. He has advisors who have clients. So he's popular. Yeah, he is a visionary. He's very popular, and quite honestly, he understands market narrative. I think he understands consumer. I think he's a really smart guy. However, this is where you and I, living in a smaller city, and him, who is in New York City, we have different opinions on these things, right? The way that we live our lives is completely different. When you look at someone who lives in Ohio or Saskatchewan or Manitoba to somebody who lives in Toronto, I mean, I was in Toronto recently and speaking with my friends there, we are completely different people. And it's the way that we live our lives day to day. We accomplish our almost every task differently because of the way in which our cities are built.
Yeah, population density.
Everything, right? So this is a New Yorker speaking about how important Uber is without the context of someone from Ohio or Utah or Denver. I think that while the population density gives this a lot of runway, and I think there's a possibility there, I am still of the opinion that Uber does go vertical and they can add amazing tools where I think they become a travel-oriented business, something that would do well to acquire an Expedia, something along those lines, where they can integrate into your Air Canada app or into your United Airways app, into that sort of let's call it business line. I believe that there's a ton of opportunity there. I don't know where it ends up. Honestly, a credit card company should be buying an Uber because they can integrate their services into, or their rewards services into what they're providing. Not that that'll ever happen.
And make that use case so much easier for
100%.
The consumer. I just used all of my points that I've obtained over the last probably 5 years for one flight to Europe. That's just in about a month's time. It's just absolutely soul crushing.
I know. Business owners who get to run all of their their purchases through a card that they can also use, they're just laughing at us, being like, "You guys are fools, fools." I earned that many points in a 2-week period.
Yeah, exactly.
But moving on, I want to talk about at least something that I didn't really know about much until today. And I think this is kind of a hot button topic for anyone on Twitter, but even just a millennial. Most of us grew up reading Barstool Sports.
Or at least you found yourself watching content that they're putting out.
Yeah, completely, right? I have read it since 2020, maybe even earlier than that. And I remember the days when they used to throw university parties. Yeah.
Yeah. Yeah.
So, sorry, 2010. Gosh, that's how old.
So you probably quit in 2020, but
I quit Barstool Sports when I was 26, 27, mostly just because I didn't have room within my content consumption budget to make it worthwhile for myself.
To continue watching frat guys smash Bud Lights on their head.
Yeah. And not that there's anything wrong with that.
No.
I think what's really interesting, though, is what's occurring right now. Because I've been moderately interested in where Disney's going. I think that they've really struggled with or around the narrative of, obviously, lockdowns were terrible for parks. Then they made this massive shift into Netflix-style streaming services. They've been enormously successful in acquiring a ton of subscribers. There's not a lot of profitability there. The margins are crappy relative to their parks. The stock itself, Disney, has underperformed the index, and it's one of the longest standing companies in America. They're profitable, but not as much as you wish they would be. The stock was at 202 in the middle of 2021. Today it's 88. It's been hammered. It's down a lot. And they've fired their CEO. Bob Iger's back, the King Bob. And they're trying to change the direction. And they have this massive asset, in my opinion, with regards to, and this is an ESPN, but it's still attached to the cable bundle, which it has this weird bifurcation of who's purchasing it. You have us on one end, which I should say myself on one end, who's never, ever had a cable subscription in his life. And then there's the older generation, which continues to have cable.
And me.
And you. But you are a boomer. So there's this weird dynamic in this market where those people are all dying and they're moving into old folks' homes, or they're not exactly where you want to be advertising. Advertising dollars have shifted. It's no longer going to cable TV, but sports is still the number one spot for acquiring new eyes, fresh eyes, live. There's nowhere else to do it, quite frankly. Netflix's business has shifted where they've now added an ad tier. This ad tier, in my opinion, is going to continue to become dominant on the Netflix side. They are going to be our cable TV. It is a fact that it's coming. Like, I don't care what anyone says. You'll never convince me otherwise. However, the ad-free tier and HG tier, you think is expensive now. You haven't seen anything yet. It's going to be obnoxious because they want to sell you ads, because that business is way better. Just look at Facebook. They are the greatest ad delivery business to ever exist, with the exception of maybe Google. Netflix is going for that market. And all of those cable dollars that used to be at Disney, they used to be at AT&T, they used to be at all of your cable providers, is shifting to this new market. Now, how do you acquire eyeballs? How do you build and improve your net margins? Well, sports gambling just so happens to be becoming legal.
Notwithstanding the fact that it doesn't necessarily align with the Disney brand,
which it doesn't,
we'll
right?
take that, but how everything with these releases is ESPN. Like, there's no mention of Disney unless you're obviously going into an article and saying, well, this is the actual publicly traded ticker that's involved here is Disney, but ESPN is the one. So yeah, the Disney unit is partnering with Penn National. So this is where the tie-in with Barstool comes in, to rebrand its Barstool Sportsbook as ESPN Bet, which will launch in the 16 states where Penn is licensed later this year. Alongside the transaction, Penn has agreed to sell 100% of the full Barstool media company back to the founder, David Portnoy, in exchange for certain non-compete and other restrictive covenants. So we'll get into that in a second. But Penn has agreed to pay ESPN $1.5 billion in cash over the initial 10-year agreement for ESPN Bet. The company will also grant ESPN approximately $500 million of warrants to buy 31.8 million of Penn shares that will vest over the next decade. ESPN could receive a bonus of up to 6.4 million more Penn shares if ESPN Bet hits certain thresholds, which obviously are not disclosed at this time. So I think it said something like, from Penn's standpoint, who had obviously partnered with Barstool and had made these inroads, they had I guess, casino-related, gambling-related inroads in a number of states. When they first partnered with Barstool, they've expanded to more states over the past 2 or 3 years. Barstool's reach, from my understanding, was about 8. I need to find this number. Just call it. I think it's 117 million users. I'm not sure if it was. I think monthly active users.
I thought it was daily active, but yeah, it's probably monthly active users.
And then versus 8 million with Barstool. So you think the reach difference?
It's not even in the same. It's not even in the same
category.
Universe,
Yeah, exactly. So ESPN, obviously. I mean, I guess I was wondering while reading these articles, like, what other options were out there for ESPN. Like, why does Penn make the most sense in relation to this relationship? Is it probably the cheapest, or is it the most incentive based, where they're able to, obviously they're going to Penn and saying, hey, like, you're going to benefit greatly from having our user base. So here's this $1.5 million deal that you're going to sign. We want a bunch of stock options in relation to this, compared to if ESPN were to go to a DraftKings, call it, or whatever it might be. But that's who they're competing against. They don't want to partner with someone. They want to build up their own thing. And so to me, this deal it's going to be very interesting to see the uptake on ESPN. Obviously, we've probably bashed ESPN a little bit with certain things in relation to their connection with cable and their inability to necessarily have the same kind of growth as, like, from a streaming standpoint, or probably have made some missteps along the way. But as you said before, from a reach standpoint on live content, there's nothing better than sports still. And from a main demographic standpoint as to who's spending money, obviously the people watching sports are very attractive to both advertisers and sports books or whatever it might be. And where we could see this going in the next, call it 5 years, with the kind of rebranding of ESPN too. I think they've put a lot of money into content creators. I mean, I'm not sure if we actually ended up talking about Pat McAfee. So he would be a pretty well-known sports figure over the past 3 years, kind of an ex-NFL player, kind of spun off of Barstool and created his own kind of media empire in Southern United States. Got huge popularity, was getting better numbers than obviously ESPN shows. What did ESPN do? They fired a bunch of their long-standing people, analysts and on-air personalities who did not kind of cut it at the end of the day from a viewership standpoint and content creation standpoint, and have brought on Pat McAfee's show and all of his staff, and they're now.
He's got an $85 million 5-year contract with ESPN. So
they've taken their I'm sure their total budget for that spending has probably remained similar, but they've completely shifted away from not shifted away, but they've really cut back on the on-air personality side of things, the traditional sports
They got rid of a lot of guys.
A lot. And now they're going towards, obviously,
new distribution. They're buying distribution. And your new eyeballs, and I would even argue a younger demographic, is going to be watching Pat McAfee. Whereas the older generation will always be watching the ESPN Sports Desk, whether they have their old, remembered, highly paid sports broadcasters or new ones at a lower price point. I think that there's something interesting going on here, a redistribution of the pie. And this is in my opinion, the right move from Disney's point of view.
100%.
I think that while they have ABC and all of these old legacy, all this legacy content on their end that they're dealing with, they're probably going to spin off and sell, and it's all going to be for a huge loss and write down. But the ESPN asset is incredibly valuable, and it should be and should remain something that they perhaps monetize traditionally, but then make a long-term 25-year pivot to where media is today, and whether that means they're going to have deals with specific TV distribution or YouTube distribution or Instagram or acquiring people that already have that distribution for tens, if not hundreds of millions of dollars. This strategy makes a lot of sense. And adding that sportsbook piece, the part that is incredibly profitable for them outside of advertising, and doing so without having to deteriorate the Disney brand and the ESPN brand. The ESPN bet makes a lot of sense in terms of like what the brand says. Its separation and not being branded alongside Disney makes a lot of sense. Now this...
Well, it's also completely normal now just to have sports and sports betting hand in hand, whereas a decade ago, 15 years ago...
Well, it was illegal.
Exactly. And every piece of rhetoric out of every major sports league in North America was like, we'll never do that.
Yeah. And now Wayne Gretzky is pushing
that's right, BetMGM.
BetMGM. So this makes a lot of sense. Disney and ESPN is allowed to come second because they have the backing to do so and the balance sheet to do it. Not only that, they're coming with more eyeballs than anybody. Does this mean that is this bad news for FanDuel and for DraftKings? I don't care, actually. It's more of a I think this pie is ever growing. This is not a pie that's stagnant. My belief is that gambling as a percentage of people's spend is going to continue to increase. I don't think that that's great for society, but I just think it's a reality. And this is an interesting shift. Now, what does this mean for Barstool? And I've long been a big believer that customer acquisition costs at a certain scale of business is a really good strategy. I think that Penn made a name for itself just by associating itself with Dave Portnoy and the Barstool Sports gang. Obviously, this merger was bad for business for Barstool Sports with regards to their growth and their, I don't know.
What made them Barstool?
Yeah, exactly. And it was a liquidity event for Dave and the rest of the team there. I think that you can't see it as anything other than that. It was a genius time. From a timing perspective, the stock went from $4. Penn stock went from 38 to 4 to 140, and now we're back to 28. It's been quite the roller coaster. People probably remember the Creed Take Me Higher videos from the middle of the pandemic where the stock just wouldn't stop going up. No one can deny the promotional ability of Dave Portnoy. I can only imagine the legal bills, though, of dealing with him. And, I mean, I'm, to a much smaller scale, understanding that having any sort of media when you're in a highly regulated industry is a struggle and can be time consuming, but also limiting. And you really need to figure out where's the money being made? How do I navigate this? And for him, it really seems like he got paid. He's going to keep all of the money that he received. So they paid $551 million, they paid at a valuation of $551 million. They bought 64% of Barstool Sports. That's my understanding. After two deals.
Yes, yeah. Well, the company was sold for $500 million to Penn in 2020. 3 years later, or earlier this year, that was the original valuation was at $500 million in 2020 for 36%, and the final 64% closed earlier in 23 or late 22. And then, obviously, in a short term here, it has been. Gifted is the wrong word, but the actual equity and control stake of Barstool has been given back to Dave for $0 in terms of actual cash exchanged. But I had made mention of the non-financial covenants around that. And I guess one of them is financial in the future. But if Barstool is to sell in the future, have a liquidation event in the future, Penn gets 50% of the profits of future liquidity. And Barstool can't advertise any sports books, and Barstool can't launch its own sports book. So I don't know if that's in perpetuity, if it's for a certain amount of years, or if it's just until they renegotiate this deal in 5 years once Penn has seen how ESPN has worked out and we'll see where Barstool is at. I think a lot of people's reactions to the threads and the and the information around this, the articles, is that obviously Penn has now traded up to ESPN. Dave did for those who actually have followed Barstool, he did an emergency press conference, which is him sitting at a desk, standing usually next to a water cooler and giving it. But he talked about how he's obviously from the standpoint saying, I still have Penn stock. I'm holding Penn. I think I've had a good deal with Penn, but I knew from early in the onset of this acquisition that it was changing what Barstool was, and what we had set out to do was going to be very difficult because of the regulation and the limiting factors of being a part of a regulated industry, both from the betting standpoint and from obviously being attached to a publicly traded company. And he, I think as a founder and what he believed in terms of his vision for the company, he saw that slipping away. And obviously this opportunity came up where Penn wants to I'm sure from Penn's standpoint too, this acquisition has not gone exactly as planned. So the fact that they're able to trade up, and then at the same time, it's almost like hey, we're not going to make you pay for everything, but we're going to limit what you can do. But this also gives you full control of your actual media side of the business and where you want to take this, which is kind of what, if we want to talk about wherever Barstool started in, late 2000s, early 2010s, and what exploded it, it was its ability to be as Dave put it, a pirate ship. There is no regulation. They can put out whatever they want, whenever they want. They don't have to be careful about what they're saying. They can just do their content, don't have to apologize to anybody. That's what they want to do. And obviously, I think the fact that Penn has still attached itself to Barstool in the sense of future liquidity, they must view this as being something that could potentially still pay off in the future and continue to grow in value. Because I don't think they would have attached that or stayed on from that standpoint if they thought we need to completely remove ourselves from any attachment with them. So it's going to be, I'm not sure, obviously Dave and the rest of the Barstool think tank will have some ideas about what they're going to do. I think such a big piece of their content, or at least stuff that I continued to tune into my late 20s and early 30s, was the betting side of things, because they would kind of dive in on that, obviously from an NFL standpoint specifically, and they have a ton of content around that. And so it'll be interesting to see how they replace that. Can they still do the content generation and give opinions, obviously, but then just obviously can't do the sponsorship side of things or the advertising promotion side of things with sports betting. It's going to be interesting. So and then from Penn's standpoint, I think this is a no-brainer in terms of them attaching themselves with a brand and a user base that should give them immediate returns.
Yeah, and I need to make this clear, because I think a lot of people think Dave Portnoy made this, arguably a great transaction here. Got a liquidity event at peak valuations. Mm-hmm. He then held his stock, maintained his brand. It kind of plateaued for a couple of years. They tried the sportsbook thing, didn't work out, but I think it did. So this is where I believe this was all worth it for Penn. So, they have total assets of $17.5 billion. This acquisition was, call it, what would you say, 3%? Mm-hmm. Of asset value.
Yeah, dropping the bucket at the end of the day.
It's really nothing crazy for Penn, but also it now gave them a brand. No one even knew who they were. If you think about what they own in terms of assets, they have a bunch of horse racing tracks. They have some casino assets, Boomtown. They have a few things that people just truly don't know a lot about. Now, fast forward to today, we're talking about it on podcasts. They have a relationship with arguably one of the most famous sports commentators who isn't at a big brand in the world, or in America anyways. They have now put themselves in a position where they could be in a room with Bob Iger. I don't think people quite understand how big of a deal that is. They just did a deal with ESPN Bet. They probably would have paid $2 billion to get into that room to get the opportunity to run a sports book for the biggest sports brand on earth.
Yep.
So, was this worth it? Penn is laughing right now. They would give up Barstool Sports 100 times to get to go and, at least in my opinion, have a 5-year chance at building the largest sports book in North America, with the best sports brand in North America, with some of the best assets in North America, and all of the leverage on earth. Like, the only thing I can think of that would be better than moving in with ESPN would be somehow, some way getting a deal with the NFL. A single deal with the NFL, which is never going to happen.
They'll never do that.
Ever.
Yeah.
So pretty smooth operating here. I think this was a really great move on both parts probably. I think Dave won. I think Penn National Gaming has done an incredible job. And arguably, this is a win-win across the board. Interesting. It'll be really interesting to see where Barstool Sports goes from here. I'm guessing it will become ever more triggering, and they're going to continue to really push the envelope like they have ever, like probably since 2021 and prior. I'm guessing they'll go back to the pirate ship. So that'll be fun to watch.
It'll be interesting to see all of the drama that will come out of this for sure.
So continuing on with sports.
Yeah, maybe the last thing today. I know we've now teased a real estate update 2 straight weeks, but I don't think we have time to dive into that as much. But so next week for sure. Anyways, we like to touch on this every time there's a new release. Sportico, great follow on Twitter for all kind of sport related content, kind of the business of sport, etc. Have now recently released a ranking of all 152 teams in the Big 5 North American leagues, so NFL, NBA, NHL, MLS, MLB. And so, Joel, out of the top 40 out of the 152, how many of the 32 NFL teams do you think are in the top 40?
So, if I was being honest in answering this question, you asked me prior, so I know the answer, sadly. I said 30, and I actually thought you said top 100, not top 40. So if I was really being honest, I would have guessed 15 probably. But it's 32?
All 32 NFL teams. So Dallas Cowboys at $9.2 billion. So we'll get into maybe a couple of the things here. We say Dallas Cowboys $9.2 billion on Sportico's rankings. Now we know, for those who would connect the dots back to our discussion around the Washington Commanders' recent sale, that was for essentially, I think it was $6 billion and change. Was it higher than that? $6 billion and change, I think, was the total. I'll have to maybe fact check myself there. But anyways, that you would think the valuation of the Washington Commanders, if we go through this list quickly, is $6.05 billion on this list. So I think it ended up actually selling for slightly above that when we take into account
$6 billion by Josh Harris.
So I think the $6.05 billion valuation on this Sportico listing would be, I guess, pretty accurate. It says 6.05, but it actually, I think the team itself plus real estate, et cetera, actually pushed it kind of closer to 7 at the end of the day. But anyways, what these rankings are not necessarily obviously what someone would pay. Like, I think Dallas Cowboys would actually sell for well above $9.2 billion. Sportico's, they have I don't pay for their premium content, so I can't see the exact formula in relation to coming up with this, and maybe I should, just to get a better understanding. But I think a lot of it's based off of, again, historical data in terms of their revenues and their kind of reach outside of their sport and what other things they might have from a branding standpoint. That's not just, hey, every Sunday we play. It's what does the Cowboys represent in the state of Texas and the country of the United States and the continent of North America, etc. But anyways,
it means everything.
Yeah. So Dallas Cowboys $9.2 billion tops the list. They are $1.6 billion clear of number 2, which is now the Golden State Warriors, which is actually, that kind of interested me. So the NBA has 4 teams in the top 40. The Major League Baseball rounds out the other 4 with kind of the teams that you would think the major centers: the Yankees, the Dodgers, the Red Sox, the Cubs. And for the NBA teams, it's Golden State, the Knicks, the Lakers, the Bulls. So those, I think if you were to look at the top 40, you'd be like, yeah, that all kind of makes sense. I mean, it is kind of slightly shocking that you got the Cowboys at $9.2 billion, and then number 40, you have the Cincinnati Bengals at $4 billion. The fact that they're all in there in the top 4, all 32 teams in the top 40, just again speaks to the dominance and what the machine of the NFL is, and how the kind of rising tides raise all boats type thing with in terms of team value. They've really been able to, like, I'm not sure when Cincinnati last sold or was acquired, but even if Dallas, what did Jerry pay for him? $150 million. So 61 times what he paid is now what it's worth.
Not bad.
So that's really interesting. The other kind of tidbits, I'm just taking a few tweet notes from Eben Novi Williams, who I'm not sure if he's part of Sportico or just commenting on it, but only 2 NHL teams in the top 75, and that would be the Maple Leafs at $2.12 billion, the Rangers at just a shade over 2. The LA Football Club, which would be part of MLS, is above 17 NHL teams, which is very surprising. So Los Angeles FC. So there's 2 teams in LA. I actually thought the Galaxy were more popular, but LAFC is at 900 million. So yeah, above 17 NHL teams. And there's only 5 MLS teams now below the value of the Arizona Coyotes, which sits at 465 million. So
good job, Gary Bettman.
Good. Well, and so again, the context of this, I think there's probably less variability on the value at the NFL level. NHL, for example, Ottawa Senators just recently sold for a shade. The valuation was basically right on $1 billion. What it sold on this list, it's at 655 million. So call it the hype machine that's currently around the acquisition of sports franchises obviously created a bunch of value. There's whatever the ownership group that viewed Ottawa as a good investment obviously sees this as paying off into the future, however long they decide to hold it for. So this needs to be taken with a grain of salt, and maybe there is more intangible or unrealized value in some of these NHL franchises where they think, and this would actually go similar to a conversation we've had previously on why there's been such an influx in North American investors going overseas into Europe and investing in soccer clubs, etc. I mean, Saudi Arabia obviously making investments into Premiership clubs as well, and F1. Those leagues, specifically, I'm going to talk about Premiership football. I think the viewpoint is that there's more growth potential there for that to become a more North American, just more of a North American sport, consumed more in North America, and there's more room for revenues to grow on that side of things. So they're like, if we can take kind of the model that we've done in North American sports and be able to apply this in Europe for Premiership clubs in England or take your pick kind of thing, they see that can be a better long-term investment because it costs, basically the barrier to entry and the cost that it would be to acquire a New York Jets or a Washington Commanders in comparison to making an acquisition of X percentage of pick your football club is a lot lower, and they think that there would be more growth potential there. Potentially the same kind of ideas around the NHL. So 655 on this list from Sportico for Ottawa, obviously $1 billion was paid. Whatever your asset is worth as much as someone wants to pay for it, and that was $1 billion in Ottawa's case. So if you apply those metrics to a bunch of these teams, then potentially that pushes the NHL teams further up this list.
Oh, completely. I think just by it's kind of like you never want to be the most expensive house in the neighborhood, unless you paid 160 or 150 million for it.
Because then you're just a boss.
Yeah, well, then you're dragging everybody up with you. I do believe there's something to be said for that. And obviously buying NHL hockey teams for some of these people and the amount of money that they have, it's literally a drop in the bucket. Yeah, I don't have many comments here. I'm still disappointed with a lot of the strategy coming from the NHL. I'd really like to see them move a little bit faster and break a few things instead of being so conservative. But, I mean, that's the nature of the beast, and I don't really have much more to say. Should we move on to recommendations?
Let's do it.
So I went to Oppenheimer alone last night. My kid,
congratulations.
My wife is in Invermere with the little guy, so I have this week as a single fellow out on the town.
What better thing to do than go crush some popcorn and watch a good movie?
Exactly. And I went and saw Oppenheimer. It was really good, a little long. Really enjoyed it. John had a fantastic way of looking at it. And what did he say? I got to bring up our group chat, but he basically made reference to the movie being a really great view into what it took to build something that could fry that many people. And it was kind of a sad
I think
view.
Lots of people's that I've read, it's like one of those movies where you have to see it, but it's not one that's necessarily going to be on your rewatch list.
No, I think that's true.
And because of the sentiment you leave, you're saying, like, if you really understand what the mindset behind that group, the Manhattan Project, et cetera, and what that meant, is like that kind of gives you that uneasy feeling. And so that the reaction to it's almost like it's a beautiful piece. Like, I mean, I don't think Christopher Nolan's ever done anything that's not
Been
amazing.
really good.
And there's so much thought that goes into it. And I think the detail that, obviously a longer movie, it really, really dives into the details. But
I want to bring one thing to light that I think is important. I believe that event, like, I think the circumstance of everything was just like incredibly challenging and difficult. But what it has given society and the fabric of human, of how we interact as humans, it's given us this nuclear protection. Mm-hmm. And a lot of people view nuclear as being a danger. Mm-hmm. I believe that nuclear specifically has given us the nuclear option, which effectively is this game theory where everybody has one, so now nobody goes to war. And since then, Earth has been more peaceful than it has been for 30,000 years. And while obviously that's really hard to digest and think about when there's the invasion of the Ukraine happening, and obviously there's still war on Earth, relative to other past history, it's more muted, even while our weaponry has been more powerful than ever before. And I think that is powerful, and I think when you think about it from like a macro level, it's sort of nice that we're not worried about, or at least we haven't been worried about, what nuclear war looks like, because of just that option being something that almost all developed countries have. And we're just staying in line because of it, right?
Yeah. Yeah, I think obviously those kind of things can change with one button and one psychopath, but it's, to your point, it is crazy to think about the advancements are all related to deterrence at the end of the day, outside of 1945. There hasn't really been another event quite like that. So I haven't seen it yet, so I'm not going to give my full opinion, but that's kind of right up my alley in terms of historical things that we wouldn't necessarily learn in school, and sometimes the dark side of our history as well. I'm not saying it's not interesting, and it's not, and I'm not even necessarily going to take a side on all of the developments from that project, et cetera, but it's something that's not necessarily like you learn about the bombings of the two cities in Japan, but you don't necessarily learn into the details of how it came about and what you have to seek that out yourself. So seeing that in a major motion picture and obviously done by one of the best directors of our generation, I think it's obviously a good mix. So I started reading a book this week.
What?
Yeah. So again, historical based. It was actually, I think, originally published in 2014, so it's an old one, but I'd actually saw it on I don't listen to Joe Rogan very often, but he had Annie Jacobson on. I think it's within the last year anyway. So she was the author of this story or this book called Operation Paperclip, which is I was going to read this synopsis. So Operation Paperclip was a secret United States intelligence program in which more than 1,600 German scientists, engineers, and technicians were taken from the former Nazi Germany to the U.S. for government employment, and after the end of World War II, between 1945 and 1959. So it is, again, I would say you would have to definitely be interested in the facts of that time. It's not necessarily talking about war stories per se. It's more so talking about the lead up, the last probably from 1943 to 1945, the downfall of the Nazi regime, and talking about the Allied forces, I guess, mission to, at the same time, obviously push back from just like the war standpoint, but also to be gaining intelligence. And because it's pretty well documented, obviously, how much more advanced Nazi technology was at that time in comparison to other developed countries. And so them going through and understanding the chemical warfare, biological warfare measures that they were taking. And at the same time, it was basically like the political science leaders of that time and in North America, and I'm sure in Soviet Russia as well, were basically saying the next thing that we're going to have to deal with is Soviet Russia versus the US. And so it's an arms race in terms of technology and information that we're going to have to take. And Soviet Russia was coming from the east, Allied forces coming from the west, there was basically a race to see who could gather the necessary information that was left over, hadn't been destroyed yet, and the assets in relation to that, which were the brains of some of these scientists who did unspeakable things and were in charge of unspeakable things, but then basically making a decision to say, for the betterment of our country and our development from a technological, astronomical, whatever it might, or
astrological.
Yeah, I was trying to say, like, from like the space developments, etc. What information can we take, and what brains can we take out of this? Like, I'm about a quarter of the way through the book right now, but basically talking about, some people who were up for Nuremberg trials originally that got taken off and were given employment in the US and vice versa, people taken to Soviet Russia and everything kind of being excused. So not a cheery, happy thing, but obviously I'm interested personally in that kind of stuff. I know there's a lot of history buffs, and again, something that you don't necessarily learn about in your typical school year, and obviously the dark secrets around that time and what happened to some of these people who were obviously viewed as, people that were in charge of concentration camps that were, operational related people. Mm-hmm. Nuremberg trials, whatever it was, sentencing, killed, whatever it might be. These folks were the brainchilds around a lot of this stuff and were sacrificed in the name of coming over and working for their previous enemy, whether it be the U.S. or Soviet Russia, and both building up those programs to eventually.
Could you imagine us somehow pulling that off in today's society? I can't imagine it.
No, I can't.
It wouldn't.
I don't think it would happen anymore. But actually, I shouldn't say that.
It might get done, but it would be done privately somehow. I mean, it really just.
Yeah, and I'm interested to learn about the exposure of this, because that's the one piece that I don't know how this all came about.
But even then, we know so much now about each person on Earth. Any involvement in something so horrific, we wouldn't be able to just wash it under the rug. Like, even the idea of having these programs where we're able to, like, shuffle someone off into, like, the heart of Saskatchewan to protect them from, I don't know, the Hells Angels or whatever, because I just don't know if that's even possible today with cameras and social media and those sorts of things.
Like, the stories are wild. Like, it's like they were like them going into research facilities and finding papers that had been forgotten and or were flushed down the toilet, but the toilet didn't work when they did it, and like finding documents and like basically, you imagine the resources would be scarce at that time in comparison to what we have now, but then connecting the dots and finding related information and having obviously insiders that are that are kind of crossing the line because they know Nazi Germany is falling, and people switching sides to make deals, all this kind of stuff. So all that stuff is interesting to me. So that might be a boring thing for 75% of listeners, and it's not like your every chapter. Operation Paperclip is the name.
I was going to guess that it was somebody turned a paperclip into a mansion, and that was their.
They did the bartering trade all the way up.
Yeah, Burning Man. Yeah. That's it for me this week.
That's it for me. We'll talk to you next week, buddy.
Take care.